Every month, a single number from the US government can send markets soaring or crashing the jobs report. This headline figure, Non-Farm Payrolls or NFP, shows how many jobs were created or lost last month. It's the clearest snapshot of America's economic health, watched by Wall Street and the Federal Reserve alike. The Fed's dual mandate is to keep prices stable and the job market strong, but these goals often clash. A hot job market can fuel inflation, forcing the Fed to keep rates high. If the job market weakens, the Fed's entire strategy shifts. NFP excludes farm workers and a few other groups, focusing on the core of the US economy. High NFP means businesses are hiring and confident. Low or negative NFP signals trouble ahead. Lately, the jobs data has looked strong at first but then gets revised down, raising doubts about the true strength of the labor market. These negative revisions have made investors and the Fed nervous. It's like seeing an oasis in the desert, only to find it's a mirage. The real state of the job market is less robust than it appears. That's why this single number has become the most important data point in the US economy. Every month, it can change the direction of markets and the Fed's next move. Investors, policymakers, and workers all wait for it, knowing it could signal a turning point. The stakes have rarely been higher. The next jobs report could change everything. Imagine the next jobs report comes in far below expectations or even negative. Suddenly the Fed's focus shifts from fighting inflation to preventing job losses. A weak report would be a clear sign that high interest rates are hurting the economy. The Fed's likely response? Cut rates to stimulate hiring and spending. For Wall Street, this is the pivot they've been waiting for. Bad news for workers, but good news for markets. Investors would immediately bet on rate cuts, sending stocks higher. In today's environment, weak jobs data is often seen as good news for markets. Strong data means rates stay high. Weak data means relief is coming. It's a strange dynamic, but it's driving every market move. The jobs report has become the trigger for the next big shift in monetary policy. The Fed is waiting for clear signs before cutting rates, aiming to avoid reigniting inflation. But a sudden drop in NFP would force a rapid pivot, supporting jobs over fighting inflation. This would accelerate rate cuts, changing the entire investment landscape. Lower rates boost bond prices and make growth stocks like tech more attractive. Gold and Bitcoin could rally as real rates fall, but not all sectors benefit. Industries tied to economic growth, like manufacturing and energy, could struggle if job losses mount. Investors would need to be selective, favoring resilient companies over those dependent on a booming economy. The Fed's next move will reshape portfolios everywhere. For now, everyone is watching for that pivotal jobs number. A single report could flip the script for markets and the economy. The stakes? Nothing less than the direction of the US recovery. The Fed's balancing act has never been more precarious. Investors are bracing for impact. The next US jobs report drops this Friday, one of the most anticipated moments on the economic calendar. At 8:30 a.m. Eastern, the NFP number will set the tone for markets and the Fed's next move. A strong report could delay rate cuts and weigh on stocks. A weak report could spark a rally and signal the start of easier monetary policy. For investors, this is the number to watch. The jobs report isn't just data, it's the key to the Fed's strategy and your portfolio's future. Mark your calendar, because when the number hits, markets will move. Will you be ready?